Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Puet Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're focusing on Puet Technologies, and there's a lot of buzz here.
A lot of buzz, yeah.
Yeah.
And it seems to be specifically because of their niche in this massive AI data center explosion that's happening.
Exactly. It all comes down to their core technology.
Let's start there then. The key seems to be their proprietary optical interposer platform.
It is. That's their moat. It's all protected by intellectual property.
Okay, so what does it do in simple terms?
It allows for the wafer-scale integration of photonic and electronic components.
So think of it as stacking everything together really, really efficiently.
Precisely. And the benefit you get from that is just tangible. We're talking about a reduction in power consumption by up to 80% in AI data center interconnects.
80%.
80% compared to the traditional pluggable modules you see everywhere else.
And in a world where the electricity costs for AI are becoming a critical problem, that's not just a small edge. That's a massive competitive advantage.
It's huge. It also creates really high switching costs for their customers.
So once you design their tech into your system, it's hard to get it out.
Very hard, and it positions them, very favorably against the bigger players, even giants like Intel or Broadcom when it comes to cost efficiency for 800G and 1.6T optical engines.
Right. And speaking of validation, the recent acquisition of Celestial AI by Marvell is a huge deal here, isn't it?
It's a massive stamp of approval.
Because Celestial was a Puet customer.
Exactly. It's seen as a strong validation of this underlying technology. Marvell wouldn't buy a company whose core tech depended on something that didn't work.
Okay, so the tech is solid, it's validated, but let's talk numbers, because that's what the transition story really is.
Right, let's look at the financials. In Q3 2025, revenue was about $0.30 million.
Which, on the surface, missed consensus estimates.
It did, but you have to look at the context. The hypergrowth narrative here is just undeniable.
What do you mean?
That revenue was up nearly 8,000% year over year.
From a near zero base, of course.
From a near zero base, but that jump, that massive jump, it confirms that commercialization is finally happening. They're actually shipping product.
The real signal, then, isn't just that revenue number, it's the order book.
That's the most important piece. They secured initial production orders totaling $5.6 million.
And most of that is for the AI space, right?
Right. There's a specific $5 million order for 800G optical engines, and those are aimed squarely at AI data servers.
So now let's address the elephant in the room, profitability.
Yeah, that is still a long way off. Their trailing 12-month net losses are around $50.55 million.
That's a lot of cash burn. But the balance sheet tells another story.
It does. It's surprisingly clean. They have zero debt.
Zero debt. That's rare for a company at this stage.
It is. And they've secured a substantial amount of cash for their runway. Most recently, through a $75 million equity raise back in October 2025.
And the total equity they've secured for this commercialization phase is what, around $250 million?
Around $250 million, yeah.
That liquidity is absolutely crucial.
It is. It mitigates the immediate risks of dilution while the company just continues to burn cash to scale up production.
And that production scaling is happening where?
Specifically, their manufacturing capacity in Malaysia. That's through their partnership with Globtronics.
Okay, and what's the target there?
They're targeting over 1 million optical engines annually.
So we have the tech, we have the initial orders, and we have the cash to build it out. Let's look at the market sentiment. What are we seeing in the charts and the market flow?
We're seeing some constructive action. The sentiment is mixed, but it's definitely tipping bullish.
And that's because of these specific catalysts we're talking about.
Exactly. Technically, the stock is trading above both its 50-day and 200-day moving averages.
Which is a classic signal for accumulation, right?
It signals accumulation. And we saw that notable 14.9% surge after Northland Securities raised their price target.
Right. They saw it as a potential breakout from those prior holiday lows.
Mm-hmm. And we're also seeing elevated call option activity.
More than usual.
For passing 5-session averages, yeah. And at the same time, short interest is declining.
That kind of flow.
Mm-hmm.
It often suggests that the professional money is moving in, or at least accumulating ahead of a big ramp up.
That's the read. And beyond the market flow, the catalyst calendar itself is just packed.
So what's next?
Well, they're working with partners like Semtech on the next generation, the 1.6T receivers.
But the more immediate thing to watch for.
Updates on their Infinity shipments.
Yep.
That's the big one. Those are going to the key AI integrators.
And those are expected ahead of the Q4 earnings.
Ahead of Q4 earnings, which should be around March 2026.
Yeah.
This ties directly into that macro trend we talked about, the explosion in AI data center capital expenditures.
Okay, so everything's pointing towards that Q4 update. But as with any emerging growth company, we have to look at the risks.
Of course. And the primary concern remains execution risk. It has to be.
The Q3 revenue miss, even if the growth was huge, shows that scaling isn't always a smooth path.
Exactly. Any delays in qualifying and scaling that Malaysia production facility that could severely hamper their ability to turn those orders into revenue.
Right. And unprofitability is a given for now, but the valuation is, well, it's elevated.
It is. The stock trades at 13.9 times price to book.
Which leaves it very vulnerable if those 5.6 million in orders don't materialize fast enough.
Very vulnerable. And despite that big cash raise, dilution is still a factor you can't ignore.
We saw that recently, didn't we?
We did. The recent 29.61 million share sale, it caused a 7.31% price drop.
So that confirms the market is still very sensitive to any capital raising.
Very sensitive, even when everyone knows the cash is needed to fund the growth.
So let's bring it all together. What's the final takeaway here?
I mean, at the end of the day, POET Technologies is a high-risk, high-reward proposition. Simple as that.
But it's positioned directly at the epicenter of this AI data center bandwidth explosion.
Exactly. Their optical interposer is a validated technology, they have major orders in hand, and they have strong financial backing to actually execute the production ramp.
So the entire investment thesis really just hinges on one thing.
Execution.
That's it.
The key thing for you to watch is the conversion of that $5.6 million backlog into actual revenue.
And the Q4 earnings update in early 2026. That's the moment of truth. If they execute, this company is positioned for potential multifold returns as the AI market scales.
If you found this analysis into POET Technologies insightful, please remember to subscribe to Smart Wealth with Joshua for your daily analysis.